All right, welcome back, everyone. If you've ever just felt completely overwhelmed by all the financial advice out there, maybe you've wished someone would just take those massive 10-part trading crash courses and distill them into a single, high-impact explainer. Well, you're in exactly the right place. Today, we are taking hours of complex stock market concepts and transforming them into one clear, updated blueprint for your financial freedom. Let's just dive right in.
So here's what we're looking at today. It's a simple three-pillar blueprint. We're going to figure out exactly what to buy, exactly when to buy it, and finally, how to put your wealth on autopilot safely. Let's not waste any time here.
Section 1. The magic of compounding and building generational wealth. Honestly, if the stock market has an absolute superpower, this is it.
Okay, get a load of this number. 1,400 crores. It's mind-blowing, right? Our source actually ran the math on this to show how long-term compounding works. If you invest 1 lakh a month, which is a lot, sure, and compound it at an average of 15% annually over 50 years, your total out-of-pocket investment is 6 crores. But the final wealth generated? A whopping 1,400 crores. It feels like magic, but it's literally just math. And hey, even if you start with a fraction of that amount, that explosive exponential growth works exactly the same way.
So, how do we actually harness this engine? First up, you've got to know the rule of 72. You just take 72, divided by your expected annual return, and boom, that's how many years it takes for your money to double. Looking at index funds like the Nifty 50, historically, they've returned around 15% annually. That means your money is doubling roughly every 4.5 to 5 years. And the best part about doing this through a systematic investment plan, or SIP, it completely defeats market volatility naturally. You're just investing a fixed amount every single month. Market drops? Great, you automatically buy more shares on the cheap. You don't even have to try to time the market. The system just does all the heavy lifting for you. All right, moving right along to Section 2, selecting the best stocks in our Fundamental Analysis Masterclass.
Okay, the absolute most critical thing here is knowing the difference between price and value. Price is simply what you hand over, but value, that's what you actually get. Think of it like real estate. Picture 2 flats right next to each other, both priced at 1 crore. The price is identical. But what if one is a beautiful 3 BHK with a park view and the other is a cramped 2 BHK staring at a brick wall? The 3 BHK gives you way more value for the exact same cash. It's the exact same with stocks. You got to look past the price tag and analyze the actual business.
Which brings us to intrinsic value. This is the true underlying worth of an asset completely separate from whatever its current market price says. The golden rule of value investing, and Warren Buffett absolutely swears by this, is to only buy a stock when its market price is lower than its true intrinsic value. Basically, you want to grab a fantastic business when it's on sale.
Well, how do we actually find that value? We use this sort of cheat sheet of 4 key financial ratios. First up is PE, or price to earning. You ideally want this under 20. It just tells you how much you're paying for 1 single rupee of the company's earnings. Then PB, or price to book. This compares the market price to the company's actual assets. Lower is definitely better here. Next is debt to equity. Keep this low. Debt isn't always terrible if they're expanding, but their capacity to repay it, that's what really matters. Finally, the current ratio. This looks at short-term assets versus short-term liabilities. You want this higher, like above 1 or 2, meaning they have plenty of cash to cover immediate debts. Simply put, we want companies with high assets and low debt.
And beyond all the math, just take a quick glance at their balance sheet checklist. You want sales going up year over year. You want profits going up year over year. Are total assets increasing? Good. Are total liabilities decreasing? Even better. If a company checks all 4 of those boxes consistently over a few years, you've likely found yourself a real winner.
So we know exactly what to buy, but when do we actually pull the trigger? That brings us to Section 3, timing the perfect trade, mastering price action and technicals.
Technical analysis really just boils down to finding zones of high probability, support versus resistance. Support is the buyer's zone. Think of it like a floor. A stock price drops and buyers aggressively rush in like crazy because it's suddenly a bargain, bouncing the price right back up. Resistance, on the other hand, is the seller's zone. That's your ceiling. The stock climbs, and people who bought it cheap decide it's time to cash out. They start selling, and that huge wave of supply pushes the price right back down. I absolutely love this analogy from our source because it perfectly captures human psychology. Imagine your whole neighborhood is full of houses worth 1 crore. Out of nowhere, every single person decides they want to sell their house on the exact same day. If there aren't enough buyers, what happens? One guy panics and says, I'll take 80 lakhs just to get it sold. The next neighbor gets scared and says, I'll take 70 lakhs. It is the exact same human panic at a stock's resistance zone. People rush to book profits, it's a chaotic game of financial musical chairs, and the price just crashes back down.
Now, drawing these zones by hand can be a real pain, but here's a massive shortcut: pivot points. This is a fully automated indicator you can just slap onto any chart. It does the math using yesterday's trading data to instantly plot your exact support lines, S1, S2, and resistance lines, R1, R2. It literally removes all the guesswork. If the price breaks a resistance, it usually runs up to the next one. Break a support, it drops. Traders use this hack to easily set their stop losses and time their profit targets perfectly.
All right, on to the third pillar. Section 4, the 1-minute ETF strategy, automating your wealth. This takes literally 1 minute a day, and over the long haul, it's almost impossible to mess up.
First up, what exactly is an ETF? An exchange-traded fund is just a basket of top stocks, like the top 50 in India with Nifty Bs, or the S&P 500 in the US. You buy and sell them just like normal shares. But here is their absolute superpower: extreme diversification. A single stock, it can go bankrupt and drop to zero, but an index ETF, practically never. Because if one company in the top 50 fails, they just boot it out and replace it with the next top performer. It's built-in safety. So here are the dead simple mechanics of this strategy. Step 1, open your app and check the index daily. Takes about 60 seconds. Step 2, is the market red today? Is it down? Take your monthly budget, divide it by 20 trading days, and invest that small fraction right then. Step 3, is the market green? Did it go up? Then do absolutely nothing. Just hold your cash. You are exclusively buying when the market is bleeding, heavily averaging down your cost. And since top indices always trend upward over time, the payoff when it recovers is massive. But listen to me, please take this stern warning seriously. Never, ever use this daily averaging strategy on one single stock. If a fundamentally weak company is tanking, buying more of it is a financial death sentence because it can easily go to zero. This strategy is an exclusive superpower for ETFs, simply because an entire index of top companies will bounce back. Individual stocks might not.
Okay, let's tie it all together in Section 5, your ultimate wealth blueprint. Let's get you actionable right now.
I'm going to challenge you directly right now. 10%. I don't care where you are in life. If you're making 10,000 or 10 lakhs a month, you absolutely must systematically invest a minimum of 10% of your income. It's going to pinch a little at first, for sure, but paying yourself first is the non-negotiable step to getting that compounding engine running.
Got that 10% habit locked in? Awesome. Now check out these advanced accelerators from our sources. Don't just stay local. Expand horizontally to the US markets with ETFs tracking the S&P 500 or NASDAQ. Why? Because you get a dual benefit. You profit from the biggest tech companies in the world, and you get dollar-cost averaging. Historically, as the US dollar appreciates against the rupee, your investment automatically goes up even if the stock price flatlines. And honestly, thanks to platforms like IND Money, you can use fractional investing. You don't need hundreds of dollars to buy a whole share. You can invest whatever small amount you have into a fraction of an ETF.
Well, that brings us to the end of today's Explainer. We've seen how compounding works actual miracles over time. We learned to spot true value, decoded the psychology of support and resistance, and gave you a 1-minute strategy that literally tilts the math of wealth generation in your favor. So here's my final question for you. Are you ready to dedicate just 1 single minute a day to secure your ultimate financial freedom? The strategies are there, the blueprint is clear, the rest is entirely up to you. Thanks so much for hanging out with me. Keep learning, keep investing, and I'll catch you in the next Explainer.